Welcome to this week's version of Nichols and Dimes, our weekly video series. Well, the markets obviously are in a turmoil right now with the major indices getting hit, growth stocks, the risk trade, if you will, we've talked about the last few weeks, has really been getting hammered. And unless you're in cash or shorting or buying inverse ETFs, or maybe you're long oil, you're probably not a happy camper right now, as the financial markets continue to be challenging for most people. Well, we talk about bear markets. What's a bear market? You may recall a bear market is a decline of an index of 20% or more from a high. And we've seen the S&P, at least as the most recent, enter bear market territory. We saw the NASDAQ entered bear market territory earlier this year. The NASDAQ's down over 30%. Well, how long do bear markets last? We're going to jump in today for a brief history lessons, because that's one of the questions we get a lot. Well, okay, we're down. How long is this going to last? And I should note before we jump into the data, it's our opinion that the markets will continue to be challenging with more downside pressure. And that will only change, in our opinion, if and when inflation is under control. And now, of course, with the Fed continuing to be committed to rising rates, raising rates to tame inflation, I guess, and again, unless that happens, meaning inflation's tamed, the markets will likely see more volatility and potentially more downside. So let's dive into the numbers and look at the data. So how long do bear markets last? Well, look how bad things were in the financial crisis. The market was down from peak to trough 57%. So from peak to trough, on average, that lasts about 12 months, and it takes about 2 years or around 21 months just to get back to even. Now note, the average bear market, at least from the mid 40s, was down on average, again, about 32%. Now, as I noted earlier, the S&P is down around 20%. The NASDAQ is down around 33 or so percent, depending on what, when you're measuring or when you're watching this video. So how long do bear market last? Again, they last around 21 months or around, let's call it 2 years to keep things simple. Now, note, 7 out of the last 12 bear markets have bottomed in 46 days or less once the 20% level was reached. So again, we mentioned we just breached on the S&P the 20% level. So, and history shows that at least 7 out of the last 12 bear markets, the bottom was reached within, let's call it a 60-day period of time. Again, 5 out of 12 were over in a month or less. So that's encouraging news. But again, it's our position that and unless inflation is tamed, and if and when the Fed stops raising rates, which again, they're raising rates to tame inflation, we think things will continue to be challenging. So brace potentially for some more downside. So just some deeper data. Here again is the bear market since the mid 40s. Note that it takes time again for the market to break even from when we're down 20%. So a little over 2 years. So again, really what we need to stress here is one needs to be patient and nimble. And I know sometimes when the market, think about it, the market has really gone straight up since February of 2020. Well, it's really March of 2020. It peaked February 2020, and March 23rd, we've really gone straight up since last fall, and obviously we've seen a large retracement quite quickly. So we continue to be patient and nimble in this economic environment because there's a lot of challenges. So again, note the bear market could fall even further, as I noted a few times, primarily in our opinion because inflation continues to be challenging for most folks. And obviously with rising rates hurting companies' profitability, that's really hurting the market. And as you know, by doing some simple math, if you have a bigger loss, you obviously need a bigger gain just to get back to even. So for example, if the market is down 23% as defined by the S&P, which again, it's down around 23%, we need to get Just to get back to even, we need to get a 30% return. So this is why we stress on a fairly consistent basis. It is so important for investors, in our opinion, especially if you're nearing retirement or in retirement, to have a proactive way to hedge your portfolio, a proactive way to protect your money, because you don't have a long time horizon, again, to make up for what you lost. And if you do lose big, let's just say losing big is somewhere around 25% or even more, you need to get 30, 35, or even 40% just to get back to even. Now, of course, if you're drawing down on your portfolio because you're taking income, or of course, if there are consistent inflation concerns, your purchasing power is likely going to continue to be eroded. All that to say is, if you would like a second opinion on a portfolio or financial situation, just check out our website. You can click on the Contact Us tab in the upper right-hand corner, and then we're certainly happy to chat with you to see if we could add some value, or if nothing else, maybe to answer some of your questions about what's going on in the financial market, and most importantly, how it affects you. Thanks again for watching. Bye-bye.